Hey everybody, Courtney Smith here with Wall Street Winners. Wow, what a week we've had. Let's break this down quickly because so much is happening. This, of course, is happening like unbelievable. But okay, let's take a look. Look at the S&P 500. By the way, let me jump out and be bold. I think the dip is over. But let's take a look and break it down. Here we see the S&P 500. You can see the plunge-o-rama. You can see how on Friday we stabilized, formed what's called a doji day. What that is it's where basically the open and the close are basically the same price. And furthermore, we closed near the high of the range, high of the day's range. So that was pretty bullish price action. Let's take a look at the purple predictor. I highlighted this last week. I talked about the failure top. I talked about how the purple predictor was breaking down. And now you can see it's not breaking down anymore. We're seeing that the smart money is using this dip as a buying opportunity. Let's take a look at the Dow. Look at the Dow came right down to that uptrend line. I'm not a big fan of uptrend lines, but nonetheless, you can see that that's what happened. What's also happened is in the purple box in the upper right-hand corner, which shows that there was a massive switch to the red line being higher than the green line. In other words, there was more selling pressure than buying pressure, and that selling pressure remains in the marketplace. But notice how the selling pressure, the red line, came down, although there was no buying pressure. So here in the Dow doesn't look quite as good as the S&P. Well, what about the NASDAQ? Well, the NASDAQ actually is where the action is. This is actually, we've seen the NASDAQ led the decline, but now I think it's going to lead the rally. Look at the purple predictor up above the price action. Look at the doji day. We broke above Thursday's high. This looks, I don't want to say it's good, but it's much better than the other two big indices. So look for this market to be setting in a low. Seasonality, when we broke 164, we switched to neutral. There is no period of the year really where it's negative seasonality. This is an ugly looking chart. IWM, you'll notice we don't make a doji day, but the purple predictor is a bit bullish. But still, seasonality gotta set aside. Now, according to Stock Trader's Almanac, highly recommended, we should continue to move higher from this point on. According to Ned Davis, well, it should be choppy, and guess what? We got the choppiness that we were expected. Nonetheless, all of these are looking, let me go back to this one. All of them are bullish from now until the end of the year. So really, what are we looking at? Well, the market's doing, according to Ned Davis, it's doing what it should do, but we should see this market turn around and start to rally more now, into the end of the year, actually. The yield curve had been rallying. We got from about 70 up to 1.00. So this was quite bullish, actually. And then the yield curve came down a bit just in the last week. Why? Because interest rates dropped. Bonds rallied as a flight to quality. You see, when the stock market drops, then people rush into bonds and safe sectors, which is what they did this time. So we got the rally in the bonds as expected, which then led to the yield curve coming down. But nonetheless, the yield curve is looking much better than it was before. Now, asset allocation, people rushed out of the stock market and into the bond market, so asset allocation collapsed, although on Friday rallied a little bit. Our stock market risk indicator, as you can imagine, came under pressure, but it came under pressure the week before, which we highlighted as something to be looking at here in Wall Street Winners. Global shares collapse-o-rama, look at that, much, much, much more bearish than the U.S. stock market. Bonds, as I say, rallied late in the week as flight to quality, but I don't think we really want to be long bonds. I think this is just a bear market rally. Bond key factors. Now let's break this down. The green line is the bond yield, and you can see that the bond yield went way up. Underneath that is the chart itself, the CRB, which suggests higher interest rates. Excuse me. Then we look at the blue line, which are 10-year Treasury yields in Germany. Now, these two things, the CRB and the 10-year Treasuries in Germany, both I highlighted last week as suggesting higher interest rates. Now, the one that was neutral was gold down at the bottom, but gold's now going up, so all three factors are now suggesting higher interest rates. Now, let me go back here. Bonds went up late in the week, which means lower interest rates. 1 second, please. Excuse me. All right, I'm back here. God, I got something in my throat here. But now we see higher interest rates, and this is something that is negative for the stock market. The dollar came down a little bit, no big deal. I think really it's all a gigantic trading range, and who cares? But this is something I highlighted last week, and I said that if we broke above those highs, I would get long gold. So we should now beat long gold. The collapse in the stock market led to a bunch of buying of gold as people kind of fled into quality. They bought bonds, they bought gold. I'm now bullish on gold. Not wildly bullish, but still, I think we've put in a bottom for now. Our indicators, the top indicator, really kind of neutral. The middle indicator, kind of neutral. But the yen did rally, and that got us more bullish on gold. Fully paid up members, I'll show you more when we get into that section. Oil came down. I talked about this last week. Oil's not going to go down much more. We've seen the bottom of this dip, and we should see some stability here, and then we'll start to rally a little bit slower, but rally back up towards the old highs. And finally, Bitcoin came under pressure here. We're back down to the lows that we made earlier last month. Not quite down to the 58.94 level, but you can see that's where we're heading. Look at the purple predictor. The purple predictor is collapsing right now. It's gone from bullish to neutral, but the momentum is very, very poor here. So a break of the lows at 58.94 would get me short. Other than that, I just think this is a boring market and really not really worth trading at all. Now, upcoming events, October 26th and 27th in Dubai. I'll be teaching our Futures and Forex Trading Masterclass. We've just booked a new event here in November, 11th and 12th, I believe it is, Option Success School. We sold out the one in October, so we booked a new one to get all the overflow. So we still have seats available for that one after selling out the last one. And then coming up in January, Extreme Profits, which may be the last time we ever teach that class, coming up in Dubai. Now, also, please check your email. I'm really building a case for a financial crisis, a bear market. This is the first time since 2007 and 8 that I have called for a negative market. I've been super bullish up until now. I'm not super bullish anymore. So now it's not going to be here this year. I think that the dip we're having in the market right now is not the financial crisis, but everything is falling into place. So please make sure you have a copy of this special report. It is free, but go read it. How to Profit from the Coming Financial Crisis. In addition, coming up, I have a series of emails. We're also launching a new course on how to make money in bear markets, because I want everybody to not suffer when the bear market comes. I want people to make a lot of money. Bear markets are quick, and so we can make a lot of money very quickly. So make sure you pay attention to the emails I'm sending out to you. All right, that's it for you freebies, fully paid up members. Hang on there just 1 second.